it is my view that we are in a broad topping process here. I think valuations reiterate that. I think there's all kinds of reasons to believe that even though it is very hard to call to the week, to the month, the quarter, or even sometimes the year, we are getting very close to another kind of move down that is going to, when you zoom out over a decade, going to look like a lot of chop back and forth.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Today's guest is the perfect expert to discuss a year as volatile as 2025 has been. Cem Karsan is founder, chief investment officer, and managing principal of Chi Volatility Advisors and Chi Wealth. He's widely known as Cem Karsan on X Twitter. Heading into 2025, Cem warned us that he predicted it would be a year of heightened volatility, and that certainly proved true in the first half of the year and again in recent weeks. But what about the road ahead? Are we through the worst of the bumps, twists, and turns that the market will throw at us, or will the ride remain rocky in 2026? Let's hear straight from the man himself. Cem, thanks so much for joining us today.
Good being back, Adam. Good to see you.
Thank you. Great to see you. First off, let me just reiterate the props, because I remember interviewing you going into 2025, and you said, hey folks, I think this is going to be a more volatile year than the past couple ones, and that certainly proved true in spades just a couple months later with the whole, April swoon and the Liberation Day freak out and all that stuff. It did kind of get less volatile as the markets just took an escalator higher for much of the rest of the year, but then starting about a month ago or so, it started getting kind of bumpy again. Where are we in the volatility story here? Have we seen the worst of it? Did we get it out of our system? Or is 2026 looking like it's going to be a repeat of 25 from a volatility standpoint?
Yeah, so if we back up 4 or 5 years ago, I was very clear we were entering a 15 to 20 year period that looks very different than the last 40 years. And not to start like so
no,
off the ground,
it's very helpful. So yeah, please do the refresher.
But it's so important to understand that we are not in Kansas anymore. This is not the same environment of a Fed dominated, globalization increasing, tech low interest rate environment, right? A tech driven world. Now, some of those things are still with us, but I've been very clear that the way we're likely to move forward here, which in my opinion, and I've been very clear about this, is driven primarily by a demographic and populist kind of impulse. Even though it will be through many quarters and years of counter trend things along the way, are largely going to be a period of rising interest rates, of increasing inefficiency, deglobalization, increasing global conflict, a period of likely towards the end slowing, antitrust and slowing corporate earnings growth. That sounds really scary, and it's not going to happen overnight. This is a big process. But again, we started really talking about this in 2021, and again, correctly called it 22, almost to the week, the beginning of the decline there. The view is that in nominal terms, we're likely going to have a lost decade to 15 years in equity markets, and in real terms, likely real meaningful losses to a portfolio. And the way you invest in that environment is dramatically different than how you invest in an environment where interest rates are decreasing secularly, and globalization is increasing, all the things that come from the regime. I like to say that if you got the broad picture right, that interest rates were going top left to bottom right for 40 years, you would have gotten very clearly a tremendous amount of profits over 40 years. That one understanding was incredibly important. You would have had been invested in growth. You would have bought the dips. You would have stayed very long beta. You would have been focused on real upside convexity for 40 years, and you would have been incredibly wealthy. And a lot of people got that, right? Whether either lucky or otherwise.
I was going to say, sounds like a lot of boomers.
Yeah, exactly. But if you get this one thing right, and I want to be clear, which is very different than that environment, that you're focused on non-correlated investment, focused on capital efficiency, right? And taking advantage of the tools of a period that looks much more like more recently, 65 to 85 or 63 to 83, right? That 20-year period. Or, again, heaven forbid, a period like 1930s and 40s, right? You are going to, you can succeed. There's incredible opportunities during volatile periods like that, but it's not as easy as buy and hold. And you need to have a very different playbook. We are fortunate to live in a time where there are more opportunities to take advantage of that type of outcome. And there are tools, but they are not necessarily as easy as buy and hold. So that is the big picture, and we've called for that. And again, I think that is where we are. Where are we in the context of that? Well, we had a 22 decline of 25%, ended up down 18 or so, and then we had an incredible run from late 22 all the way through 23 and 24 into, again, here the more volatile kind of, call it sideways to slightly up, 25. It is my view that we are in a broad topping process here. I think valuations reiterate that. I think there's all kinds of reasons to believe that even though it is very hard to call to the week, to the month, the quarter, or even sometimes the year, we are getting very close to another kind of move down that is going to, when you zoom out over a decade, going to look like a lot of chop back and forth. Again, I think you can go look at the 60s and 70s as a proxy for what this kind of generally looks like. It rhymes. A lot of the structural drivers are the same. But again, it doesn't tell you much of what's going to happen this year per se, or this quarter, or this week. Those things are driven more by flows, and we can dive into that here as we kind of zoom in a little bit. But before we do that, to get us more now in the neighborhood from big picture down to kind of the right zip code, I think it's important. This is something I referred to about 2 years ago, about a year and a half ago, in early 24. I brought a very interesting kind of data set out to public, and people kind of get captured on it, and it was incredibly valuable for a lot of people. It was talking about election cycles. I don't know if you remember this. Some people will, who are our followers or have listened to kind of some of the things we've talked about. 2024 was a presidential election year. And if you really dive in and think about presidential election years, most people are like, those are incredibly positive years, is what the general kind of zeitgeist is or thought is on that. The reality is they're about
because the current administration, people think, have juiced everything to try to make it look great going into the election.
Yeah, and it's not just this administration. If you take 100 years, apologies, of data on presidential years, there's a lot of stuff that'll go out that'll say something. I think it's about 13 and a half. I have to go look at the exact numbers, but largely quite positive years, right? And the idea there is most administrations going into the presidential election want to be on a good footing, because if the market does well, historically, they get reelected. Right? That's the theory. That's the idea. The interesting part is if you dive in a little bit deeper, and this was started from a qualitative perspective, not a data mining perspective. I think that's important. I've talked about the 60s and 70s, how they're similar in a lot of different ways. If you go look, because of this populist period, if you go look then at the elections that specifically happened during that time, and again, driven by populism. Populism itself is political, right? So it would make sense that elections are important, maybe more important during this period. And if you go gather those presidential election years, again, not the midterms, not presidential, we're going to get to midterms here in a second. There are 5 elections that happened from 62 to 82. 5 elections. Okay. All 5 of the elections had double-digit positive returns, and the average returns for those 5 elections is 21.5%.
Wow.
If you take out, that's amazing, right? But the consistency, the scale is pretty amazing. Yep. But what's more impressive is if you take out those presidential election years, 5 of them, and there's 25 total elections, right? Every 4 years, 100 years. The average return is actually 5.5% for presidential elections, which is way below the long-term average.
Yep.
So they are very concentrated, very consistent. It is not that all elections, in my opinion, presidential elections are positive years. It is presidential elections in populist periods. Now, what happened in 2020, which I would argue is the first real populist election? 18.5% annual return. What happened in 2024? 25% return.
Mm-hmm.
Average return of 21%, right? Again, could be a coincidence. Very consistent. Another very impressive thing, those 5 election years, actually, this is even more impressive. Those 5 double-digit election years during the 62 to 82 period. Do you know what the nominal return was from 62 to 82? Nominal, not real. Real was way worse. 0%.
I was going to say pretty flat.
0%. Okay. 62 to 82, 20 years, nominally 0. Real terms, a loss. Actually, not nominal, sorry. In real terms, a loss. I apologize, I misspoke. In real returns, about 0. In nominal terms, there was a gain, but relatively small. I misspoke there. But importantly, really low returns. And of those 20 years, 5, a quarter of them have a 21.5% nominal return. So what do you think happened the other 15 years?
Right.
Negative
Not so great.
Negative 3.5% on average the other 15 years. So dramatically black and white type outcome here for presidential election. We talked about this at length in early 2024. We were talking about how based on that is one major reason you really wanted to be really bullish into 2024. And as I mentioned, 24 was at 25% return. What we didn't do a year and a half ago, which I wish we did, is go look at those other 3 years of the election cycle more closely. Because I just was like, oh, the other 3 years are just bad. Let's just say like they're bad in general. Incredibly new, consistent piece of information that is, again, it's just screaming at you. It's so stands out dramatically relative to the other data. Midterm years, 1962 to 82. You have 5 of them. All 5 were negative and meaningfully negative. They had drawdowns between 23 and 49% peak to trough.
Whoa, wait, 29 was the low?
23, I think, is the low.
Sorry, 20, like the best of the years was down 23.
Worst, that's the worst. That's the least. Sorry, those are drawdowns. So that's the smallest drawdown that happened.
Right, that's what I meant. Your
not the total
best year was
performance.
only down 23%. Yeah.
Yeah. That was the smallest drawdown. Right.
Yeah.
That doesn't mean that's how the year ended. And they.
Okay. Sorry, drawdown throughout the year, not
throughout the year.
Not
all
the
have
return
meaningful big drawdowns is the point, and they're all, I believe, all but one are negative years in total. Most of the drawdowns end in about October. Again, if I showed you a chart, it's eye-popping, and the consistency. A lot of those declines begin in either in Q4 of the year prior or early into the midterm year. Why does this happen? Why such consistency? Why did this, again, I've already said the presidential election cycle itself matters tremendously during a populist time. It makes sense. I want to also reiterate, this is the other interesting fact that I think we all know in the back of our minds, but just to verbalize it, 62 to 82, we have how many presidents? 20 years? We have 5. The average presidential term was just over 4 years. Almost nobody got reelected. If they did, like Nixon, they got impeached.
Right. And Kennedy got shot. Yeah.
Correct. Then, the important thing is, yes, there's kind of things that seem like, oh, they're incidental, but assassinations, people getting kicked out of office, these are all tied to the anger and aggression that happens due to the populist impulse and the frustration of the young. So it's not just being kicked out of office via elections, it's being kicked out of office through violence, through political other means. And when you go look at the last 40 years, you know what that average election kind of term is? 7.1 or 2. Dramatically different.
Mm-hmm.
And again, it just falls in line with how contested the elections are during these populist periods. And that contested environment leads to more need to stimulate during the presidential year to drive positive outcomes so that hopefully there's some ability to get reelected, right? Sound familiar? Does any of this sound familiar, by the way, what's going on?
Sounds like the movie that's been playing in front of our eyes.
Correct. And then what happens, inevitably, the last party gets kicked out of office, which has happened the last two elections, right? Because the problem is bigger than the person elected, by the way. And the change agent, or the entity that's coming in to be the new president, soon, as I said very clearly at the beginning of this year, just wait, because the pitchforks will be on his lawn next. It's just how it works. And where are we? That's exactly what's happening. We just saw a massive Democratic landslide. We are starting to see real anger and political, like the polling numbers are in free fall for Trump. There is a major tidal wave. You saw some of his MAGA base now defecting over the Epstein issues. There is a dramatic move counter, and that's classic in this period. And as that belief that we're going to get change or resolve the problems now fades to anger, more frustration, even more desire for change, eventually you head into the midterm years and they start to lose control. Nixon came in as a Republican that was supply side economic driven. And the first policy he passed was tax cuts for the rich, an attempt to roll back populist policies. Sound familiar? Mm-hmm. Within a year, he was already deploying new populist party policies. In a year and a half, he was forced into price control. This is how it plays out now. It's going to rhyme. It's not exactly the same every time. But if you can't see that what's happening under the hood and see this trend, I think you're missing the big picture. And it's incredibly consistent. So in the context of that, you have to think, okay, again, we've gone from 20-year period down to election cycle, right?
Yep.
We're entering a period that you should be largely cautious. And it's driven primarily by a likely loss of control by the administration, despite the general view that he's going to be able to do X, and they're going to stimulate, and the political environment is going to make it hard for him to control his base. It's going to make it hard for him to control different outcomes. And in terms of inflation, again, we're entering a stagflation environment. I've talked about that for several years, clearly seeing it. The most recent data coming out from Black Friday and all these other this period show it really interestingly, a meaningful 7% increase in prices sold with a meaningful, again, I think it's a 2% decrease in actual volumes. It's all driven by inflation.
Inflation, yeah, we're spending more on fewer things.
Fewer things, exactly. And so that stagflation environment, and by the way, not a coincidence why we're not getting CPI numbers and unemployment numbers anymore. I mean, people, again, this is not a conspiracy. They're trying to control the narrative. That's what politicians do. It's not just a Trump thing. It's, what happens, right? And they're increasingly finding it difficult to do that. The pressures in the system are making it difficult for them to continue to control a very difficult situation, a stagflationary environment. And ultimately, given valuations, given flows, it is likely, now they can thread the needle, anything is possible. This could go another year, they could make it, but the odds in terms of the actual pressures in the system are going to lead to a higher probability of a problem at some point here. And liquidity markets are the biggest driver of liquidity in the world. It's a reflexive loop. We've talked about that. Bigger than the Fed, bigger than the Treasury, bigger than the economy. And all those things matter. They're all big. But ultimately, the biggest driver is markets themselves. And if the economy starts to go and liquidity is being pulled from there, which it is, if the Fed is not able to react to aggressively, even if they're just kind of on the sidelines, and the Treasury trying to do it all, the Treasury is likely to not be enough. And all it takes is a little bit of market volatility and a bit of a decline. And then liquidity can really drive kind of a very different direction than it has been going. And that really is what will, if it happens, will likely lead to a bigger issue here. Now, this is not a sky is falling story. Again, I'm not sitting here saying, go buy puts to scale and get short, right? This is a distributional story, right? The reality is when you get to this point of the cycle, the left tail gets really fat. And we're at this point in the election cycle where the odds are increasing as well. That said, I started in the business in 98, saw 98, 99, 2000, 2001, 2002, incredibly. Like that was my initial education in markets. I'm telling you, at the end of a bubble, which is where we are, right? In particularly this type of populist environment, it is not going to end well. But could we see a 20%, 30% type rally before a decline? Absolutely. 100%. This is a bigger picture reality. But there are ways to take advantage of understanding where we are in that distribution. And that is way easier, particularly on a risk-adjusted basis, than trying to just be long the market or short the market.
Got it.
And
okay.
A lot to unpack there. But,
no. I want to compliment you. So you're like an interviewer's fantasy. You paint a broad landscape in beautiful color. So I just have to sit back and listen. I understand why you think volatility is going to be certainly greater for the next, where are we in your 15-year cycle, 2-3 years? So for the next 12 to 13 years. And in particular, 2026 is likely to be a rough year for all the reasons that you just mentioned about midterms. So to a point you made earlier, a lot of people made a lot of wealth by basically just being long and living their lives for much of the past 40 plus years, right? They got a little bit of a wake-up call during COVID, but honestly, the policies from COVID helped them out. And for the past 3 years, if they were just long and didn't worry, they've been fine. So my question to you, Cem, is that bolus of investor, are they sleepwalking into all this? Because they might have heard some of these warnings before, but they're just looking at their portfolios and like, yeah, this year was a little scary at times if I checked my 401k in the wrong month, but otherwise it's going to finish up 16+%. So are they literally, willfully blind to the risk that you're talking about here?
Yes. I mean, the answer is after 40 some years, right, of one regime, it is almost impossible to convince people, no matter the facts. And I have I could show you charts and graphs. So this is an absolutely awful time to do exactly what you did for the last 4 years. But it doesn't matter. People don't
nobody listened to Cassandra at Troy, right? Because, hey,
Correct.
If the Greeks aren't here, then why worry?
What's the longest track record you've seen for anything? Is it anything longer than 10, 15 years?
Right.
I mean, a 40-year track record is like, why would anybody argue with a 40-year track record? So what I'm talking about is, again, if you dig into the details, if you understand what the force is and what's driving the big picture, to me, it's clear as day. It's that clear. But it's really hard unless you really take somebody by the hand for hours at a time and show them all these things to explain the why and the how. And it's much easier to just say, and by the way, the incentives in the system also drive RIAs and people to just be like, it's simple, low cost, buy and hold, set it and forget it, and it'll work.
Oh yeah. I mean, the RIA system in general is set up to be a trust me bro system. Just give me your money and just trust me. Market will take care of you.
I mean, I think I've mentioned this to you before, but I think this is one of the most important things I can say. If you ask, I was on the phone with a relatively big RIA today. I won't name names, right? And I asked the same question I ask whenever I get on with a big RIA. What is the Sharpe ratio of the S&P 500? What do you think? And it's like,
they don't have an answer. They don't even know it.
No idea.
Yeah.
the simplest measure, the most basic measure of risk-adjusted returns. People are being hired to help people get the best returns relative to risk, you would think. Zero idea. The answer for the NERA listening is 0.35. Over 125 years of data, the S&P 500 has a 0.35 Sharpe. 60/40 also has a 0.37. No diversification benefit of 60/40. It's just driving slower. There is no diversification in that portfolio. You can achieve 2 Sharpe type returns with true diversification, not rocket science. And there are dramatically, like very well documented ways to, for free, improve those risk-adjusted returns. So that is what people should be thinking about, is risk. What is risk? And there are tools to manage risk. That, by the way, is the expertise in investing. It is easy to go buy stuff and go away for 125 years and make money.
Right.
The problem is there are 3.5, almost 4 20-year periods, 20, not 1 decade, 2-decade long periods, where in real terms, 60/40 makes no money over the last 125 years.
Yeah. And in those same periods, somebody who does invest with the type of outlook that you're recommending here, there's the opportunity for loss avoidance, right? Okay, I'm not going to sleepwalk into these downdrafts, right? I'm going to have some protection against them. But then there's also the ability to catch some pretty massive rallies, right?
There is more opportunity during these periods than other periods. There's more divergence in outcomes, dramatically so. That's actually the whole point, is that this is a time of loss of control of central bank and interest rate dominance. It is a time of deglobalization and global conflict, which means you have a dramatic dispersion in outcomes of assets, which leads to some huge winners and some huge losers.
Mm-hmm.
And so if you are prepared for these times and you understand broadly what's happening, you can find yourself in actually a way better situation than you would have in these other periods.
Right.
And
Can I make a comment for you to clarify here, which is, I can make a Machiavellian argument and I can make an altruistic argument for your type of investment strategy here. The Machiavellian one is, hey, you can make a boatload of money here and maybe like life station changing wealth, right? Where like, hey, in a regular market, everyone's doing pretty well, and it's going to be harder for me relatively to change my station to be ahead of where I am now. Whereas here, you're going to have potentially a lot of people at the top end starting to lose because they're playing the old playbook. So you can actually go from being in whatever strata you are into a higher strata, right? So that's the personal incentive mode. But then there's the altruistic one, which is like, hey, probably a lot of people you know are going to be in that loser category, right? It might be your parents, right? It might be your siblings, right? The folks that you said after 40 years, really hard to talk them into changing their minds, right? So maybe part of the message here too is, hey, you've got the ability to be the responsible one who will hopefully outperform in here, and then you can be a resource to those in your family who kind of got caught by surprise by all this. Is there truth in what I just said there?
100%. And actually, from a personal level, I cannot think of, and people will laugh at this argument, but I cannot think of honestly a higher calling at this point. I'm able to educate on what I think is an incredibly important thing, hopefully help a tremendous amount of people in a tremendous amount of, and with a tremendous impact, while still being in a business, by the way, which has the largest total accessible market of any business on the planet, which is the $500 trillion asset management world, that is 99% managed in a very incorrect way at the exact worst moment. So yes, incredible profit opportunity to be invested in, not only as an investor, but also to be in the business of that, if I am right, which I'm, have great conviction that I am, and very much at the opposition of what 99% of the world is doing.
All right. Well, Jim, if you prove to be right over time here, I will be part of the group that builds the statue to you, just so you know.
Well, again, don't need a statue. I think just helping people and being involved in that, what incredible opportunity. So,
okay. All right. Well, look, I think you've kind of woken people up to the fact that, whoa, if nothing else, Jim thinks that this could be a coming year where there's going to be a drawdown in there. There's highly likely to be a drawdown in there of at least 20 something percent, maybe even twice that, right? So going from sort of problem to solution side of the discussion, you've said several times, there are tools and there are strategies to be able to navigate this type of period. What are they?
Yeah. So you've asked me before about options. We've talked not just macro and big picture. We've talked about options, right? And I know options are scary or confusing for people, but what they are is the ability to be much more precise in terms of your positioning, right? Options represent each option, each strike at each expiration represents a moment on a distribution of outcomes for any asset, right? And so instead of owning a stock, which is just the expected value, or a bond or whatever asset, the value of that asset is just the expected value of the whole distribution. And so if you are able to instead express the opinion you have about an asset much more precisely, that takes dramatic risk off. If I own a stock or a bond or any asset, I'm taking the whole risk of the whole distribution. It is both capital inefficient to do that because I'm making a bunch of bets and putting a lot of money into things that I don't like or that I don't want to be invested in. And two, I'm taking out a bunch of risk that I don't want to be taking. So the right way to do this, and again, this is hard for some who are who are still investing in 2D world, right? Is to go replace the whole asset with the part that you want. Okay. And so what parts are worth investing in right now? I just said the distribution is getting very fat tail. We are at a very high probability. We're really far off the ground. Valuations are very high. There are a lot of risks. If things go badly, it's not going to go bad small. It's going to go bad big, right? So that's a fat left tail. Probably don't want to be short the out of the money put or the put in markets, right? So there's part of that stock that you own. Part of a stock or a bond is the put, is the downside. Don't be short that. Okay. I would argue, anywhere on the downside, you don't want to be long. Be short. I would also argue the right tail is very fat. If we go up this year, it is not going to be a small up. Why? Because there is a lot of short interest in the market. People are worried because we're at record valuations, rightfully so. Markets are efficient. Bubbles generally don't end with a whimper. They end with a bang, right?
Like a blow off top.
A blow off top. And that happens because of the very realities of people are underinvested. The entities in power know that there are problems and are trying. Again, I call it a sumo market. We have tectonic plates pushing against each other, right? That's not the same thing as two little wimpy guys pushing on each other. The market may go nowhere at one point, but these sumo wrestlers eventually, when they push off each other, are going to go to much fatter tails. And that is very much true for where we are in markets right now. So the right positioning right now is not to be long stock. It is to be long out of the money calls, maybe a 25 delta, 30 delta call, something out of the money. If markets go down, you don't participate on the losses to the downside. You lose some premium. And if we do continue to go higher, it will likely not be slow and it will be volatile. And by the way, I started calling for this several months ago. We've seen market up, vol up into the rallies, and we've had more dramatic declines. So this approach has been incredibly profitable.
Put options love big moves in a short period of time.
Correct. That's exactly right. Now, the difference of why put options are less favorable to me than call options as a replacement. I know that's confusing. People are like, wait a second.
Yeah, and I'm sorry, I meant call, but yeah, go ahead.
Yeah, call options are the upside, have much lower implied volatility. Also, structurally, because of all the buy right, people own stock. They're naturally long assets. They sell calls. They buy out of money puts. Because they're selling calls and all these buy rights exist, there is a compression to the right tail in terms of implied volatility, where there is no real volatility risk premium. There is no actual risk premium to calls. And so not only are they incredibly cheap, and they are and a great way to manage risk, there's no cost to them in the, historically. And in this environment, if I am correct about the distribution about where we are, which I think historically is highly likely, then you're getting them at a credit. So you're getting risk protection for a meaningful credit, if that's the case. And that's, again, what we've been saying for several months. And that's been an incredible opportunity. Now, this is just one of the tools. I know you asked me, like, well, what does somebody do? You're asking a much bigger question. I dove right into options, and people are probably tuning out, right? Outside of tools like options, there are incredible, much easier set of tools that you can use. One, diversification. It's investment 101, yet so few advisors do it. 60-40 stocks and bonds. Over the long run, there is zero correlation benefit, there's zero diversification benefit of bonds versus stocks. Zero. 0.35 Sharpe versus 0.37 over 125 years. Makes sense in a sense. Bonds are the bottom of the capital stack, equities are the top. They're still exposed to the same asset, right? One's just delevered,
right,
to the occurrence. Until it happens, it doesn't matter. But then once it happens, it's dramatic, right? Credit risk is the same thing as equity exposure. And so 60-40 doesn't actually diversify exposure historically. So most RAs don't deploy any true diversification, and it's the one cheat code. People think hedge funds are these guys are geniuses. Like there's got to be you got to be extra smart to take advantage of what hedge funds are doing, blah, blah, blah. By the way, Millennium is run by a guy named Izzy Englander, right? Izzy Englander was a floor broker on the floor of the options exchanges. He wasn't the market maker. He wasn't a sophisticated trader. He just knew everyone. He was a broker, and he brought everybody together. Diversification is the cheat code. It's the simplest thing on the planet. If I have 20 different managers who make 10% per year on average over a decade, sometimes they're down, sometimes they're up, but 10% on average. They each have a 0.6 Sharpe. They each have a 15% annual drawdown per year. And they're all invested in similar things. Guess what? My Sharpe, my drawdowns, they're all going to be the same. That's not diversification. But now imagine you have true diversification. When the market goes down, one might lose 15%. One might make 15%.
So this is your non-correlated assets that you were talking about.
Non-correlation. You truly, and by the way, it's not just assets, it's strategies. I want to be clear there, because sometimes just being an asset is a correlation, right? And so I can name 20 strategies that are truly non-correlated just off the top of my head. Trend following, managed futures, event-driven strategies, commodity strategies, long-short equity, long-short credit, FX trading, life settlements, legal settlements, global macro, managed futures, right? All these things are relative value, some type of timing edge, merger arbitrage, convertible arbitrage. These things are niche. They don't necessarily have a straight market exposure. And they're not just non-correlated with markets, they're non-correlated with one another. Now you have 20 strategies that make 10% on average a year, still have a 0.6 Sharpe. Each one has a 15% drawdown. On its face, they look the same as the correlated assets. But this magical thing happens. You put 20 together, you still make the 10%, but your Sharpe ratio goes to 2. Your drawdown goes to 4.
Wow.
Because you have only 1/20th of each investment with each risk. You have completely diversified your risk. You don't have a single point of failure. If you're at home and you have a risk that one thing going wrong, the whole house, everything falls apart, you would never take that risk.
Right.
Yet that's what the average RIA does. We have a single point of failure. If equities go down 50%, you lose 50% of your money. And bonds are just a deleveraging to that. There's no diversification. Instead, if you put all your bets or all your opportunities different to all kinds of different things, guess what? Your risk drops dramatically. Diversification is the cheat code. It's investment 101. Yet 99% of RIAs do not deploy the simplest idea on the planet. We should be diversified. That's the key to risk management. And you can achieve the same returns. You don't have to give up returns.
And Cem, is that just because they're lazy?
Yes. It's not just lazy. It's confusing to people.
Yeah,
Simple
but these are the experts.
sell.
These are the guys who get, licensed and go through training,
So 1982, interest rates topped at 19%. And it's been a straight line down of interest rates for 40 years.
Yeah, so they just got
Two
fat and
ideas.
happy on the trend, on the tailwind.
Yeah. And it's easy and it's cheap and it's scalable. These are sales machines. They're aggregators of AUM. And it is much easier to tell the story that stock number go up. Stocks go up over the long run. It's easy. It's simple for people to understand. Businesses make money over the long run. Okay. It's recency bias. Passive investing. This is going to blow some people's minds. Everybody thinks it was a technological innovation, a new idea that Vanguard had that completely changed the world. It wasn't around before. It wasn't something that people knew how to do. The Dow Jones Industrial Average has existed for over 100 years. Indexing has been around forever. Passive investing is just indexing. Why did we not passively invest until 1985? Because it didn't work.
Because the conditions weren't favorable the way that they were.
Because it didn't work.
Yeah.
It's worked for 40 years, and now it's the biggest thing on the planet. 60-40 stocks and bonds. That idea did not exist till the late 1980s. It worked for 40 years. And guess what? That's what everybody does because it's been easy. Recency bias. It's not rocket science. If it works, people do it. But people are always too late on the turns because what worked before doesn't necessarily work in the future. If you take a wider lens and you look at why it's worked, it's because interest rates went top left to bottom right. And now the big question is, after 40 years of interest rates going from 20 to 0, now they've gone to 4.5. And by the way, there's about a 5 to 7 year lag, again, well documented, because people borrow for an average of 5 to 7 years. Corporations borrow for 5 to 7 years. So there's a lag. And now that we're in a period where it's more likely that interest rates are going to normalize, even if they just stay here and don't go lower, we'll feel
you get this
effects.
refinancing at the higher rates, and that starts being gravity. Yeah.
And now that we're entering this period, nobody's asking the question, what if the most important thing in finance, which is interest rates, it's the discount rate, is not going to keep going lower? It's maybe going to go the opposite way. What does that change? And the answer is very clear if you look at longer terms of history. 60-40 in passive investing does not work in those periods.
Right. And so I'm going to guess, too, that you are not surprised at all that despite the administrations and Wall Street's and the Fed's, everybody's hopes to get the 10-year Treasury below 4% just hasn't proved successful this year.
Anybody who's been following me for 4 or 5 years know we've been years ahead of the stagflationary trend, the inflationary structural realities, the populist policies. They're all connected. And everything we've talked about for 4 or 5 years is happening under the hood. It's happening.
Okay. So beyond the diversification at Kai Volatility Advisors and Kai Wealth, what else are you focused on right now heading into 2026?
So risk management is not, diversification is the easy part, right? The next step is using options. I highlighted one way, which is I think the best, easiest way. I want to get that out there because I do think it's one of the best ways to do it in this environment, which is stock replacement with calls. But volatility itself is an incredible tool. My friend David Dredge uses this metaphor. I think it's by far the best one that you can use. Your average person looks at something like a long volatility strategy, which we recommend a 5% allocation to. Okay. And looks at it and says, this strategy makes 0% over the long run, or heaven forbid, loses 2% each year on average. And says, why would I ever invest in this thing? Because I can make on average 10% in equities per year. Right? I'm deleveraging to the long-term realities. That's how the average person thinks.
Right.
And I get it, because they don't understand portfolio theory or how this stuff works. But after diversification, there is another cheat code. And again, well documented. There's a ton of academic research about this, which is looking at long volatility and saying, how fast is this going to make me go? Is like looking at brakes on a race car saying, dang it, these brakes slow me down. Just because brakes make you go slower or can slow you down, give you more control, doesn't mean you should be driving a race car without brakes.
Right.
A race car with brakes wins races. Not only does it make sure you don't fly off the track, when you go around the turns, you don't have to go slow. You can slow into the turns and accelerate out of them. They allow you to take risk. They allow you to seek upside exposure. They allow you to take opportunities at exactly the moment they arrive. They allow you to accelerate out of the turn. There's a ton of academic research for this. If you put some long volatility, you don't need a lot, 5% into the portfolio, it doesn't lower your total returns through a process of natural rebalancing. It improves your total returns, yet dramatically reduces the volatility of the portfolio at the same time. Your Sharpe ratios go through the roof by simply having brakes and gas. Again, an idea that seems simple, but is completely misunderstood because people are way too simple about looking at each investment and saying, we're just going shopping. I like that thing. That makes 10% per year. I like that thing. It makes 10% per year. Diversification plus some tail, a little bit of tail to help rebalance, gain control in the portfolio, and to be more aggressive when times are right and be less aggressive when times are not right. Make for a much more robust portfolio. That's the second concept, incredibly powerful. Third concept, as it comes to equities, there is another cheat code. Warren Buffett. Not everybody's like, oh, that Warren Buffett's a genius. He'll tell you himself he's not a genius. The concepts that he uses, again, very simple idea. Value and quality investing over the long run has very similar returns to a growth type of investing. Very similar, but half the volatility. Growth stocks make tons of money in certain periods. Then they lose tons of money over other periods. And this is a diversified investment. Yeah. Can you pick the right one and get lucky? Sure. Right? If you have that skill. Great. Everybody thinks they do. Nobody really has that skill.
Nobody does. Yeah.
In a diversified approach, value investing on a risk-adjusted basis. I say value, I don't mean like value as a value trap. Really, again, a Warren Buffett type discounted cash flow analysis. Growth matters, right? In that, but what do we know? The quality of the investment. If you take that approach, you dramatically outperform on a risk-adjusted basis, which again, similar to brakes on a race car, allow you to add leverage and take risk at better times in better ways. So you actually can dramatically outperform, right? If I have a better risk reward, I can add leverage. I can take more risk. So your returns relative to risk are better, and hence returns end up being better. Invest with quality, invest in value. Don't worry about the 20 years or 15 years you underperform like Warren Buffett did for 15 to 20 years. Over 65 years, he dramatically outperformed not just the total returns, but on a risk-adjusted basis as well. Third concept, simple. People just have to be patient and take a very risk-adjusted approach to doing the simple things that work. And you will end up in a dramatically better place in the long run. But particularly given everything we talked about at the beginning of the conversation right now.
So what I'm loving about this is this is giving me like shades of Moneyball, right? Where your point on diversification. It's the analogy I'm thinking of is like fantasy football, or we can call it fantasy baseball in this example, where you could bet on the team, but the team might have a lot of players that you think are stinkers. Okay, one or two standouts, right? But so why not field your team like in a fantasy league of the exact pitcher, right fielder, catcher you want, right? You're shaking, you're nodding as I'm saying all this.
Absolutely, it's statistics.
It's statistics. Yeah, and similarly too, your point about value stocks over the long run, that's like the Billy Beane strategy of like, hey, let's look at what really matters, on base percentage, right? Guy doesn't have to be a massive hitter, right? It doesn't have to be the fastest guy on the team. He just has to prove that he can get on base more often than the average guy, right? So you're combining all these things very much like he did, and it obviously worked for him.
And when you add them all together, each one of these is meaningful, but it can be dramatic. You can achieve through diversification, through a little bit of long vol and improving your geometric returns with rebalancing through a value investing approach. You start putting these together and you take a 60-40 portfolio, which has a 0.37 Sharpe over 125 years, and you can achieve not twice that, not three times that, 400%, like hundreds of percent better risk-adjusted returns. These are simple concepts. You do not need to be a rocket scientist. Now, you can do things on the margin that can even improve it more. I'm not even talking about, a lot of the other, timing and getting the probability distribution look like. None of this involves the timing stuff we were talking about at the beginning. The thing that everybody wants to know, where are we going? When are we going now?
Right.
If I can provide value there, then we even have dramatically better outcomes.
Right.
This is just a better investment process at baseline at any time.
So let me ask you this then. So we're beginning to come up on the hour, and I don't want to shortchange you in any way. But you've clearly, it's like Liam Neeson from Taken. You've clearly got a very special set of skills here that make you feel like you see kind of the large tapestry pretty clearly, and that we are getting very close to when the world is likely going to wake up to the fact that you're onto something here, right? And it's probably going to take the world sleepwalking into the next really big, volatile year to wake them up to say, hey, the passive playbook isn't working anymore. So how excited are you for 2026, given the Chi model here?
In the words of Warren Buffett, you never know who's swimming naked till the tide goes out.
Yeah.
It is very hard to know when the tide is going to go out.
Yep.
That said, there are certain things that lead to higher probabilities of the tide coming at certain times.
Right. Like the midterm data you had shared with us earlier.
So in my opinion, and I think I'm on very solid ground, risk management is in short supply. And very few people do it. We swim with a swimsuit. I've been swimming with a swimsuit for a long time. I get a lot of like, what's the deal with a swimsuit? Looks uncomfortable. What's the deal? It's not that hard. And guess what? It's just smart. And it doesn't cost me much, if anything. But if I'm right, and the probabilities are higher of the tide going out, there's going to be a lot more interest in risk management and ways to do it going forward. So yes, I think the probabilities are high. Will it be 26? I think there's a decent odd. If it's not, I'll tell you what, I think in the next 5 years, the odds are incredibly high, right? Of the risk management part being really, really important. And when we start talking about prediction, again, a lot of academic research on this. This is Shiller's thing. Fundamentals really don't matter over a 1 year period or a 2 year period.
Right.
Over a decade, they're incredibly predictive.
Yeah.
And so I think my prediction, that the strongest prediction I can give you is that the next 10 years are not going to be great. And I think that's on very solid ground. I'm not the only person who says that. We talked to, Druckenmiller and gazillion other people who are in that same boat, who are very much better known than I am. Okay. And that prediction, if it's right alone, right, what we're talking about is incredibly important. And again, to your point, not just a benevolent, incredible opportunity to help educate people and help them in the next decade, which is what really matters.
Mm-hmm.
But also incredible opportunity in terms of business and opportunity, and potentially the biggest total accessible market of any business on the planet.
All right. Well, look, whether it takes 5 months or 5 years, Jim, we'll have you on this channel as often as you want to come on to keep us updated on where things are. And when things start getting real, then please come on anytime to call an audible and let us know, hey, this is what I was looking for, folks. This is what we're doing. But I very much respect and appreciate what you guys are doing there at Kai Wealth, and anything we can do to magnify your voice, not just for my audience, but for all audiences that are willing to hear it. I would love to be able to do.
Thank you, Adam. It's an incredible opportunity to have this platform with you, and hopefully we're reaching some people out there, like you said, helping them along the way. So anytime I'm happy to hop on.
You're very kind. And so a question that's hanging in folks' minds right now is, okay, well, geez, if I want to benefit from some of this, risk mitigation that Jim's talking about, and maybe, have my portfolio structured in this way, where can folks reach out to you to follow you and your work or potentially become a client?
Yeah, kaiwealth.com. We're also out on Twitter or X at jam, JAM _croissant or croissant, depending on your pronunciation. We definitely team up with high net worth clients and are expanding our footprint there. So please reach out.
All right. So Jim, when I edit this, I will put up the links to Kai Wealth and your X handle there on the screens. Folks know where to go. Folks, the links will be in the description below this video as well. Jim, is there anything about what you're focused on right now or what you're implementing at Kai Wealth that I just haven't thought to ask you about yet?
Honestly, again, we try and keep the process straightforward. Again, not as straightforward as just buying stocks for the long run, but I do think the implementation is more straightforward. We're on Schwab, we're on Fidelity and Interactive Brokers, and really trying to make it as straightforward for clients as
Meaning
possible.
an average person can implement this.
Absolutely. Yeah. And I think that's really important. This is not something scary or confusing. We really do try and work directly with clients to make sure they understand how important these principles are and how to deploy them. So,
all right. Just in closing, one thing I'll tell folks that maybe I'll give more detail on in a future video is the power of statistics. I was pretty terrible at statistics, but I was smart enough to realize how just unbelievably powerful they can be, and that the people who understood them, what an unbelievable advantage they have. It almost looks like magic, and you're smiling as I'm saying this, Kai, but there's so many things that statistically, the folks that know how to dig into the numbers, they can pull out correlations that make no sense to me or a regular person, but they find it in the data, and it's like black magic when they say, hey, if this is going to happen, that's going to happen. Just real quick, there's a problem called the birthday problem. And my statistics professor in business school started the first day of class off with this, where there was about 60 of us in the class. And he said, look, I'm going to bet, I'll put $5 on the table. I'll bet that 2 of you in the class have the same birthday. Not the same year, but the same month and date, right?
Right.
Of course, somebody bets him, and people start naming their birthdays, and 3 or 4 people in, somebody says, well, I've got that same birthday too, right? And he said, well, I'll bet you again. And he kept betting, and he kept winning. And people are like, eventually, like, surely we've done all the matches here, and they keep betting him, and they keep losing. And the reality is I'm doing this from memory, but I think as long as there's like 40 people in the class, he's got like a 98% chance of winning the bet. I don't think it drops below 50 until you get down to like 23 people, right?
Yeah.
You're like, there's 365 days in the class. There's only 50 of us. Of course he's not going to get a match, right? But it's stuff like that the people who really understand statistics, like you and your team, you have such an unbelievable advantage if you use that knowledge to your benefit, which of course you are, and that of your clients. So I have a huge respect for what you're doing, is what I'm saying.
I appreciate it. It's again, you don't have to be a mathematical genius to do these things. I'm not saying they're easy, but statistics is a well-known field, and there's very simple ways to understand the basic concepts and then deploy them and use them to your advantage.
Yeah, but very few people do. So
That's true.
it's almost as if you are a mathematical genius. Feel free to wear that crown. But I would say to the average person, if this sounds compelling to you, then recruit your own mathematical genius. Get them on your team.
Well, common sense isn't common, I think is the
Yeah.
phrase, right? I think the reality is there are simple things that work, and deploying them works, but often people don't take the basic steps to do those basic things. But yeah, incredible opportunities out there at this incredibly important time to do that. And hopefully this gets through to enough people to start thinking about these things.
All right. Well, Cem, as always, super fascinating, super valuable, and a privilege. Thank you so much for coming on the program.
Same, Adam. Thanks for having me, bud.
All right. Well, now's the time of the program we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. I'm joined as usual by lead partners John Lodra and Mike Preston. Gentlemen, great to see you. Mike, why don't we start with you? As I was interviewing Jim, I was thinking, okay, well, I think there's going to be a fair amount here that New Harbor's probably going to see eye to eye with, especially Jim's focus on risk management, especially for the type of environment that he sees us heading into. I know that's a specialization of you guys at New Harbor. So what were some of your key takeaways here, Mike?
Hello, Adam. I really enjoyed that talk by Jam, and I'd like to just share some of the high points, things that we agree with here, and maybe one or two things that we disagree with. But I really enjoyed the talk. And Jam talked about the last 40 years was a regime, a different regime than what is likely to happen going forward. We couldn't agree more. We think that we're actually at near the crisis and climax of a fourth turning. And anyone that, if your viewers know about fourth turnings, they know they only come around every 80 years or so. I know you've had Neil Howe in your program many times, the
Well,
author of the
we'll have him
fourth
back
turning.
on in I think early January. So he's coming back.
Excellent. Always enjoy Neil and his talk and the two books, the original one and the new book that says, the titled "The Fourth Turning is Here." We talk a lot about that paradigm because it's a paradigm that we really resonate with, and it makes it easy to explain where we are in this time, this cycle, because not every cycle throughout history is the same, and this one is not the same. It is more dangerous than any one before, at least over the last 80 years or so. So Jam talks about the last 40 years has been the regime of globalization, outsourcing jobs and manufacturing, and buy every dip. And I'd state that it's also the regime of interventionist central banking, which I think has had a lot of negative effects. I could probably argue that it's had a lot of good effects too. But the negative effects that I don't like is the increasing risk environment, the bubble and bust cycle, plus the insane wealth disparity that we've witnessed in the last 10 to 20 years. He says he thinks we entered a new 15 to 20 year regime back in 2022. Not sure I completely agree with that. I think we're still in the final days of this 40 something year regime. And I think that once we hit the crisis and climax of this fourth turning, this market will fall hard and will be an L-shaped move this time, down and sideways for years. It doesn't really matter how we label these regimes. What we have to know is that the regime over the last 40 years is different than what we're likely to see going forward. Whether we're in that new regime yet or not is up for debate. I think it doesn't happen until we get the kickoff of the crisis, which is likely a stock market crash. Jam also talked about the fact that we're going to have to live with higher inflation and interest rates. I think that's ultimately going to be right. Over the next couple of years, we think interest rates are actually going to go lower, probably in response to a falling stock market and a panicking Fed. Likely will at least drive rates down to 3% or below on the 10-year, at least in the near term. Long term, I think the effect of this, the effect that we're probably going to drive global debt to at least $50 trillion, just currently at 37 or 38. Balance sheet, who knows what on the Fed will be something crazy. We're probably going to see higher inflation that's going to stick and higher inflation rates. We might even see a headwind for the US dollar over the next 10 plus years. In other words, a different regime. Is it going to be the end of the world? No. It's still going to be okay, but it might very well mean that our standard of living goes down 20 or 30% for the average person. So something different. Now, he says that he thinks the regime going forward is going to look like 1962 to 1982. I think that's pretty much right. Maybe there's going to be a lost decade or two in stocks. So it's a high risk environment. We have to think about that. Jam talked a lot about risk, 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 how to handle that. So that does resonate with us, and that's how we manage money here. A couple other things he mentioned. 2025 has been volatile, like predicted, but it's been okay. 2026, he basically sees either a blow off top, then a bear market, or straight into a bear market. We think that we might very well get this blow off top. And he talked a little bit about replacing some of these darling stocks with long dated call options. I'm not sure that most people should actually do that. It's complicated. You face time decay. So easy to lose money buying options. Trust me from experience that probably you're better off, in our view, not doing that and then just reducing your equity exposure down to something like 30%, something that you can sit with through whatever comes, and something also that will allow you to get more engaged in the market if we see that big drop. Also talked about passive 60/40 and 100% long indexes are just going to get killed. We know that. So we talk to people that are either clients or interested in maybe becoming clients or just want to talk to us. They say that their advisor, if they have one, is always in 60/40 or 80/20. And that's what Wall Street is, particularly after 40 years of nothing but up. That's exactly what everyone's going to do. And there's no safeguards in place on how to protect those people going down. They're just going to have to sit with it maybe for the rest of their life. Because if we go down, it could be 10, 20 or more years before we really have meaningful recovery. So that's why most are in danger. And I guess I'd like to just finish my comments with what he thinks this new regime is or how you should be invested for this new regime. Jam talked a lot about true diversification, 15 to 20 genuinely uncorrelated strategies like futures, long short commodities, reinsurance, life settlements. Let me just tell you that most people shouldn't bother with that. I mean, this is not an insult to what he's saying. I just don't think that most people can really get their arms around that. If we're right and it's going to be a big bear market, just go into treasuries here for most of that money. You don't really have to do all of that. Most people are not going to be sophisticated enough to do that. That's not to say that Jam can't be successful doing it and that some others can't be successful. Maybe they can. He talked about long vol, permanent long vol. It acts like brakes on a race car. That's true as well, but buying volatility long is difficult. You're going to have to roll VIX calls. VIX being the index of volatility, which in itself is flawed. And you're going to be facing a lot of decay in those options every single month until it eventually maybe pays off. So probably wouldn't recommend that either. He talks about value and quality is better than pure growth stocks. Can't argue with that. And lastly, I guess I'd say that he talks a lot about fat tails and how to protect yourself. Again, for most people, just go mostly to cash. Do the T-bill and chill, really. It'll be okay with T-bill and chill. You're going to probably need some help on how to get in. Reach out and talk to us or somebody that you trust, or just sit and wait for the market to fall, 30+%, probably more if I had my way, and watch for Treasury bill yields to go back down. That's going to be the dangerous time that the T-bill and chill people are going to want to get in. But talk to us. We'll be happy to help. And so big bull markets don't end with a whimper. Jam says they end with a bang. So that probably is going to be, in my opinion, an all-in moment of fireworks up followed by a crash. So be careful and talk to us. We'll be happy to help.
All right, great. So two things, Mike. So a good summary. I think you would say, because I know you guys are big followers of John Hussman's work, Jem's concern that we may be having, looking at a lost decade ahead of us, really at the last sort of 15 years, that meshes very well with Hussman's forecast, and you guys pull up his chart often here, right? Which shows, doing this from memory, but it's the expected annual return, average annual return on the S&P for the next 12 years, I think. And the last time that you guys put that up on the screen, it was negative, somewhere between -4% to -6%.
It's around
which
-6. Yeah.
yeah, so that's a little bit over a lost decade ahead. Now, of course, that's not just going to be happening like clockwork every year, -6% per year. It's going to be wildly up and down. It's highly likely to be wildly up and down. Some big down years, some big up years. Again, that's everything that Jim is trying to capture here. And just to make sure I'm capturing what you said earlier, yes, Jim's strategies are sophisticated. I think Jim would say they're not that sophisticated, but just for most people, a little bit of mathiness and dealing with instruments that they're not familiar with gets pretty overwhelming pretty fast. And so your general point, which I would totally agree with, is look, if you're not familiar with this stuff, don't learn it on the fly now on a DIY basis. Either play it safer with some of the simpler strategies that you just mentioned, or recruit your math genius, as I was talking to Jim about. Either recruit him to do those strategies, or work with a firm like you guys to do something similar, but maybe a little bit more understandable to the average person. But I don't think you were saying his strategy won't work. It very well could work very well for him. It's just the average person trying to figure it out on the fly for the first time. Some of those strategies might be a little bit too sophisticated. I capture your point, right?
Yeah, absolutely. I certainly don't want to appear to be condescending to your viewers, or certainly not to Jam, because I'm sure that his strategies work and work well. My statement is that there is a learning curve involved with all of these products, and there's a tuition to be paid, and we don't want people to
Even
pay
with
it.
basic options, which you talk a lot about, right? We always say work with somebody else for a while to look over their shoulder and learn how to do it before you play in that sandbox alone.
Yeah, options are tricky. We use options a lot, and frankly have, at least personally in the past, paid the tuition that was necessary to get there. I want to help people short circuit the tuition necessary to get there. That doesn't mean don't learn it. Do learn it, and some of these things are really interesting, and you can find a niche. If you're a self-directed investor, there's a niche for everybody. Selling options is a great niche. Some of these vol plays could be a great niche. Buying options, although harder in my opinion, is another niche. So there's a lot of really neat tools, and the stock market is an infinite environment. That's what's really cool about it. But it's also what's really dangerous about it, because it can be a really hard place to learn and a hard place to find out what your own personality defects are. And lastly, if you can make 4% over the next year, which you can close to anyway in a treasury, and we think there's going to be a huge down market, think about that for a minute and think about how much you want to learn right now, because there's
Yeah.
plenty of time to learn.
If the market's down by double digits, a positive 4% return in the safe instrument feels pretty heroic, at that point. So,
Exactly.
yeah.
Exactly.
All right. Thanks, Mike. All right. So, John, coming over to you. First off, anything that you want to add to what Mike said about the GEM interview?
I think Mike covered the bases really well. I guess the only thing I would add, and as much as we would likewise be critical of the likely success of a kind of a passive buy and hold in the years to come, I also want to caution viewers that even though the table seems to be very very well set for a fourth turning kind of crises and volatile market like Jam described, and we certainly believe is the path ahead, you can equally become stuck in the mud with that view as well. All to say is that that kind of information is really important to have an awareness of, and a framework to understand the environment we're in. But it doesn't mean put your head under the pillow or in the sand, so to speak. It just means being much more tactical and having a system, having an emotionless system to navigate what are likely to be rocky waters. We're about 45% in equities right now, if we don't include 10 to 15% in gold mining equities. Based on valuations alone, if we were forced to buy and hold the stock market, the S&P, for the next decade, we could make a good case to be virtually 0% in equities, but we're not. And why are we not? Because we think there's plenty of opportunity, but one that is going to be, we think, kinder to more tactical strategies that take on risk, take off risk when the market signals suggest that's the way to be. So I just want to caution folks, it's easy to become so bought into a non-buy and hold scenario that you simply just run for the hills improperly. So you can kind of hurt yourself both ways, so to speak. I guess I would really love to chat about the options framework. As Mike said and you alluded to, we do quite a bit with options. We use very simple option strategies. And as complex as they can be and hard for most people to understand, they're actually quite simple, especially if you bring it back to what the objectives are. Quite simply, I can say quite simply, options are just a simple way, if used properly, to take an unknown scenario and put bands around it, put certainties around it. So, when you buy the S&P 500 today, you're going to get whatever the market gives you. If it goes up, you're going to get that return. If it goes down, you're going to get that negative return. Options have, you can use options in various ways and combinations and very simple strategies to say, hey, you know what? I can have upside of X%, but I can guarantee that I'll have no more downside than Y%. That's just one very simple framework to think about what options can do for you. It allows you to take the unknown and put some knowns around it. That is incredibly helpful especially when one is paralyzed, that they have this feeling of FOMO, but they also are worried about the risk they feel in their bones. You can kind of have it both ways. There is no free lunch. And what I just described there, you're willingly giving up some upside beyond a certain level. But in return for that, you're guaranteeing a protection level below a certain level. That's really, in a simple layperson's word, what options can do for you. They can take the unknown and put defined bands around it, uncertainties, if you will.
All right. So a couple of things. So for folks that haven't seen the kind of basic options 101 tutorial that you and Mike put together for this audience, I think we recorded that, like a year and a half ago. Folks, you can go watch that at thoughtfulmoney.com/hedging if you just want to get sort of a foundational grounding in how these things work. But as Mike said, John, you guys are happy to talk to anybody, for free that wants to call and inquire about how they might be able to use some of those strategies for their own portfolios, correct?
Yeah, absolutely. We do it all the time. And Adam, I'll just make a note. We put out a monthly client newsletter, and actually just this month we put one out on options. Just simple educational piece on option. We're happy to provide you a link to that if that would be helpful for your viewers. But yes, I do encourage folks to look at the video that we did with you. We covered a lot of ground in there in a very basic way. So absolutely educate yourself. Take the mystique out. They don't have to be risky, complex tools. They can be very simple strategies. It's interesting. Just this week, I think Goldman Sachs announced that they acquired a ETF company called Innovator ETFs. And Innovator is one of a small handful of ETF providers that specialize in what you might call buffered ETFs or structured ETFs that basically have these features that, hey, you can be invested in certain areas of the market and you can, make sure that you have participation to the upside, but, limited downside. These are all built with options. Now, I'm a little critical of, relative to just a simple buy and hold strategy. I think these can be useful tools to, accomplish, risk management, versus just simply owning a hyper overvalued S&P 500 and closing your eyes and hoping for the best. But with options, there is value to be added for tactical management. So I actually did a little bit of a critical video on these buffered ETFs several months ago on our YouTube channel. It's not to say they're not useful and cannot be appropriate for folks, but they're not oftentimes all they're cracked up to be, because let's take, for example, when the market pulls back pretty dramatically, these protection elements kick in and do what they're supposed to do. But it's in those times where a tactical option strategy would be very thoughtfully reduce or remove those hedges so that the subsequent rebound can be enjoyed. Oftentimes, when you have downside protection with options and you get a swift move down, if you don't reposition those options, you're going to miss the upside. So you want to have it both ways, right? So, folks can find that video if they want to learn a little bit more about my critiques of that. But I think it's really a sign of the times that you have, and Goldman paid a rich price for this company. I think they have like 21 billion in management, and I think Goldman paid $2 billion for something like that. Not a cheap acquisition. So clearly there's an appetite for risk protection, even if they're imperfect tools. I think it just speaks to the times we're in, and people, I think, are understandably concerned. And talk to someone who can have a candid conversation about the risks and rewards. We're happy to do it, of course, with your viewers, Adam. We do it all the time, no strings attached. We just love to educate about what we are passionate about, and if we can leave a little bit of insight and prudence with anybody we talk to, that's enough payment for us.
All right. Well, thanks again for doing that. You guys have helped a ton of people in the past and continue to, so thank you. All right. We only have a few minutes left, so we got to be concise with this. But John, staying with you for a second. So the conversation with Jim really was sort of looking out over the course of next year and maybe even the next 10 to 15 years. As we look at the here and now heading into the end of this year, so just 4 weeks left in the year, about a week ago, we were wrestling with the oh gosh, or maybe 2 weeks ago, did the AI bubble just peak out? Is this thing going to roll over? Last week, which had thin trading, the market stabilized and folks thought, okay, no, maybe the worst is behind us. Now there's talk of, okay, are we going to get that year-end Santa Claus rally? Looking at your indicators, what are you seeing as more likely as we end this year?
Yeah, so we've had a pretty much an abrupt about face in the last week since we talked, Adam. Our broad battery of indicators has shown quite dramatic improvement. Doesn't mean that, hey, there's no worries to the downside. It just simply means that the market has taken the bit back in a kind of an offensive posture. And we actually a couple weeks ago we reduced our equity exposure by 5%. Just yesterday, we added a cumulative 5% back in, but we did so in different sectors. So, for example, we added a small slice of a healthcare focused sector play and a global mining company play. These are copper, steel miners. So we added that back on yesterday, all because of our battery of indicators showed a pretty dramatic improvement in breadth and regaining of some key technical support levels. And it just speaks to the importance we think of, not being too emotionally and dogmatically bought into a narrative and let the market kind of guide you. But we're not 80% in equities. We think for most folks, for all the good reasons, valuations and otherwise, and where we are in this cycle, having an underweight equity exposure is almost certainly a prudent thing to do, especially for folks in their retirement or near retirement, because as much as a buy and hold approach can say, hey, over 30-year periods, the market's never lost and it's averaged this. When you're in retirement, sequence of returns is critical. I invite your viewers, if they're not familiar with that concept, just do a Google search for sequence of return risk. You're going to come up with some really important stuff. Bottom line is, when those returns happen and when the negative returns happen are critically important in terms of your retirement success. If you have a couple down years up front in your retirement, it could derail your retirement for the rest of your lives. And that's really what's at stake right now.
Okay. All right. Mike, coming to you again real quick. They were talking here, silver remains in breakout. I just recorded right before I got on with you guys a live stream dedicated to this exact topic with Andy Scheckman. But would love to give you, I know, precious metals are an important component of your portfolio there at New Harbor, but you have been tracking them for us, but specifically silver. And I want to go back and give you props. Coming into this year, you were talking about the technical setup in silver and thinking that it could really break out. And this is back when silver was in the high 20s, I think, low 30s. And certainly this year has had several silver breakouts, but we seem to be in another one right now. Silver futures were trading above 59 right before we got on here. Anything you want to say about this breakout?
Yeah, let's talk about silver here. Let's take a look at the silver ETF, or at least one of them. And for some people that tune in every week, it might be somewhat repetitive, but I think it's worth talking about.
Well, it's higher than it was last week.
It is. And so I think last week we probably would have talked about this triangle compression right here. And so this is the SLV on a daily basis. And then let me just go to the weekly just to remind people, or for the new viewers, they can see this. There was a triple top right around here. 1, 2, 3 touches. And this was around 35 spot silver, 32 on this ETF, 31 or 32 on this ETF. And we were talking about, hey, watch out for this triple top at 35. Triple tops don't usually hold, particularly in commodities, and it didn't. And so we broke out of there, formed a triangle, broke out of there. Look at that move, out of the high 30s right up into the 40s. And then we corrected for a few weeks, created this triangle. Go back to the daily. I'm a little bit surprised at just how strong this is. When we talked last week, it was in here. I was thinking it was going to compress and maybe even have a little fake out to the downside just to get people out. But boom, look at that. I mean, we went right up to 53 on the ETF, like you said, 59 on spot. I mean, these are target levels. You know, I was thinking the next spot for the next year might be 60 to 70.
Right. And just
And
to be
here we
clear,
are.
59 on futures. I don't know what the spot is today, but yeah.
That's right. It's close enough. 58 or 59, high 50s. We can say that.
Yeah.
You know, so here's one thing that's a little puzzling is how silver stocks haven't exploded even faster. Although I can tell you silver stocks have outperformed silver year to date. It seems like it's just a really thin group, and maybe Wall Street doesn't completely buy in yet the fact that these companies are doing this. But this is big. I mean, $60 silver. I'm not going to tell people to go all in, and we're not gold and silver bugs, but this is really positive. And take a look at these 4 days. It's just gap, 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 gap. Yesterday, we decided as an investment committee to adjust our hedges. We had some short call options against silver, which effectively took us out of the position because we were above the strike. Yesterday, we said, you know what? We don't really know that we're going to get a pullback. We might just literally have another $5 to $10 higher vertical with short covering before we get some sideways or down action. So we actually bought back that call yesterday and rolled it out, giving us some more upside. And as you can see, yesterday was like a little up hammer here, and today we're just pinned right at the top. Wouldn't be surprised to see it move higher. That's what happens as shorts get a little bit panicky, people rush to get in. Eventually that causes a short-term top. But I've learned the hard way, nobody knows where that top is, you know? And I guess I'll just show you some of the junior miners quickly because I was noticing that GDXJ is forming a little bit of a handle. Here's a cup, 3 days of handle. And then if we get a breakout higher, that's going to be a really bullish sign for GDXJ, I should say. GDX looks similar, but a little less defined, but it's very similar. GDX broke out of this triangle here, along with silver and gold, which did a similar thing, even though I didn't show it, and it's building a handle. So look for some consolidation and a break higher. Lastly, I guess I'll show SIL or SILJ, which is the juniors, and these are the silver majors. Same thing, triangle, breakout, forming a handle. And if I show you the juniors, same thing. Don't take my comments as, you know, as over bullishness or fanaticism. I want people to think long and hard about this because people do get emotional and they tend to get out on the swing lows and in on the swing highs. But if you have the right allocation so that you can sit with this, I honestly believe that a lot of these names that have already doubled, let's go back to SIL for a minute, go to the weekly chart. We basically broke out of, I don't know, 35, maybe 35 to 40 was the long base. Take a look, we've doubled, boom. Very common in a bullish kind of breakout situation. What I've also learned over the years is after a consolidation, if it's a real strong bullish move, these assets will likely double again. So I'm not making a prediction, but don't be surprised to see SIL, for instance, be, you know, way up there in the hundreds. We might even see a double on the thing before it's over. But don't go all in. Don't get emotional about it. You know, we're 10% in miners. There's a reason for that. We talk to a lot of people that are 100% in it. We can't necessarily say that that won't make money. It probably will. But the ride is really psychological. So very bullish. Be smart. Talk to us if you want some advice.
Okay. And for folks that want more about exactly what's going on with silver, go listen to that live stream that I recorded, the replay of the live stream that I recorded with Andy. You know, Mike here has just been talking about kind of the technical appeal of the charts right now. Andy and I got in a lot of the what's happening with the actual flows of the physical metals in the depositories right now. So there's a lot of kind of both fundamental and technical reasons to be bullish about where silver may head from here, despite how far it's moved. It's just got a truckload of momentum behind it. So, all right, well, look, gentlemen, another great week as always. Folks, if you enjoyed the discussion with Cem, would like to see Cem come on this channel back in early Q1 to give us an update on how things are going. Please let us know that by hitting the like button, then clicking on the subscribe button below. well as that little bell icon right next to it. As John and Mike have very generously offered several times already, if you'd like to talk to one of Thoughtful Money's endorsed financial advisors about your personal situation, and we didn't talk about it this time, guys, but make sure you've done everything that you need to do in terms of your end of year planning, but also setting your portfolio up for the start of 2026, but also maybe for this, the future that Jam sees in his outlook going forward. Well, anyways, you can if you don't have a good financial advisor to be holding your hand through all that to begin with, feel free to talk to one of the ones that Thoughtful Money endorsed. Maybe you might even want to talk to John and Mike directly themselves. So to set up one of those consultations, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. These consultations are totally free. There's no commitments involved. It's just a service these firms offer to help as many people as possible. John and Mike, another great week. Thanks so much for coming on here and making sense of it all for us. Certainly we live in interesting times, and we're going to find out pretty soon how this year officially ends, but I very much appreciate you guys coming back on this channel every week here to give us your, real-time live color commentary about it all, and really helping us keep track of everything as it unfolds.
Thanks so much, Adam. We look forward to seeing you again soon.
Adam, we too appreciate the time with you and hearing from your invited guests. We learn something every time. And until next week, we'll wish you a great day.
All right, guys. See you then. Everybody else, thanks so much for watching.